The line length of indicators is a unique feature to the identification of market strength of a pending movement. And there are many different types of indicator line length combinations that can be used to identify what's going to happen. And I will be identifying those line lengths around two vertical lines that I've drawn in ahead of time. And those areas we will be discussing the lengths, movements of specific indicators, and comparing those two areas prior to a gap up. So the charts that I have up on the screen are 3 daily charts. The emphasis in a 3 pattern movement or in a gap up movement, which has the 3 patterns of the proximity group, power 4 lines, and the down touch in the trend red, and then of course the high count of identical indicators in all the 5 charts are the 3 patterns. I've placed the trend chart and the power chart in the right chart here, and then I have the price, the zip, and the swing in the other chart, and with a little bit of an expanded view on the left chart. Primarily, I'm going to be looking at the middle chart and the right chart today. I'm in AKBA, and I have here two opposite price movements. One barely goes up, the yellow vertical line, and the green gaps up. And I want to define what I've got here and can compare line lengths prior to each of those movements. Now, in the power chart down here, we can see that we had a power red spike down and then a long red line coming up, and that long red line ended the day before the green vertical line, which would be 2 days before the gap. So in other words, what I'm trying to convey here is that sometimes the day before, sometimes 2 days before a high price movement, you can identify those high price movements with the identification of a long indicator line length. There, in this example here, I'm also going to be adding to that formula crossover conditions and just again comparing them. The first one I'm looking at here is power red, and power red began at minus 3.3 and ended at 1.75. It almost went up 5 points. If you look at the same indicator line over here in the swing chart, swing went up from 2 days before the green line. I gotta move my data window down a little. Swing Zion was at minus 0.88 or almost minus 0.9, and the next day it went to 2.4. And the third line that we're going to primarily look at is the swing green. You can compare red or green. It doesn't make any difference, but you do have price green at 62, 2 days before, and then 1 day before the green line, price green is at 131. So price green has gone up 69 points. If you compare the two over in front of the yellow line, you have price green at 13 and price green at 84, and that's about 71 points. So both of the price green lines have gone up about 70 points. Similarly, if you go down here next to the yellow line, the day before you have Swing Zion at Zip Swing Zion at -3.2, and then Swing Zion is at 0.19. So that difference is basically about a 3.4 difference in movement. Now, the thing that I'll point out here is that we look a lot at location as well, and by that what I mean is in the price green on the yellow line is at 84, and the price green on the day before the green line is at 131, and there's a huge difference in that in the price chart. And you may or may not have heard me tell you on previous videos before that when price green maxes out in the at 150. I've probably seen less than 50 examples in all of my time looking at price green positions above 150. They usually stop at in the high 140s as the maximum height. They will downtrends or next day down movements will occur quite well in the 130s and the 140s. So and of course they'll go down sooner than that, but that range in the above 145, when you see that, that's a good indication that you can watch that stock, because if you wait for the signal, you're going to find that one drops fairly well. Now, what I'm trying to identify and share with you is that these line lengths took place, but the location was obviously higher than the other. In the swing chart, we have next to the green line, the swing Zion line ended at 2.4, and next to the yellow line, or on the yellow line, the swing Zion was 0.19, barely over 0. And so when these lines cross over and go above, high above 0, it makes a big difference in what's going to happen in the next day or two. Tied in with that, I want to expand this the trend chart a little bit and show you what I normally will compare is the power movement line, the trend movement line, the swing movement line, and the price movement line. And in different types of movements, also the zip red line length movement. But I have a tendency to do the trend red, the power red, and the swing Zion lines in a group, because they are the big three. And if you do the zip Zion, it's the big four. The zip red, it's the big four. But the big three, for example, when they're all spiked down and lowest, they usually react much stronger than other when just 2 out of the 3 are doing it, or just different combinations of things. This is how and why we came up with the big three. Now, the thing that I want to point out is that trend red right here is at 0.26, so it's basically a down touch 0. And as as well, it is, if you haven't noticed it, we've got from down here about 5 or 6 days ahead of this, we have from this day to 2 days before the green line, we have a large right leg W higher pattern. And that right leg W higher pattern, we actually in the power chart have a right leg W lower pattern, but we can clearly see the right leg W pattern in the swing chart, and you can also see it in the zip chart in the pink, red, and gray lines, especially. The right leg W is a little bit different in the red and gray versus the pink, but the general idea you obviously see. And then of course you have the right leg W in the price pattern. Now I want to take, as I was comparing that, I saw something that I want to share with you. And I've added another line, and this line is a white line. And between the yellow and the white, we have a higher right leg W larger pattern. And between the white and over here 2 days before the green, we have a higher right leg W pattern. And you can talk about the white line being here or 2 days later. It doesn't make a whole lot of difference. The significant difference between the two and why one works and one doesn't has a couple of different factors to it. Typically, the right leg W on the right side of the white line has what we consider to be a normal right leg, and that is a down spike, a one line down spike with a higher right leg than the left leg W. Now you're gonna say, well, that's true over in this example. If you look here, or depending on which one of these three lines you want to look at. Obviously at this line right here, we're looking at a right leg W, and we have a zip Zion that is highest, and it says it's going down. So a right leg W, if you left the white line here, you've got some conflicting information that says you're not exactly in a higher right leg W pattern. You might want to look at it. But the biggest thing you want to see is the difference between the right leg W on the left has zip green at 0, whereas the right leg W on the right has zip green at 100. And this difference tells you that the buyers on the right leg W versus the buyers on the left right leg W, larger patterns, have no buyers. In fact, the buyers are leaving the market on the left right leg W. So just some significant differences in what we've got going on this right leg W. You're supporting evidence. Likewise is a red spike, where the yellow is down and above the 50, and the red is down and under 50, and that's a normal red spike, which is a reversal pattern back up. And so this right leg W tells you it's going to go up, which we get a real nice green candle the next day. And then obviously as the days go on in this left right leg W larger pattern, in other words, this next day, it's actually been a low angle down that day, and then you have 2 days of a low angle down, both days with zip Zion highest. And zip Zion highest, if you don't know it, is a reversal pattern down. There's no signal in the zip Zion highest other than it's just the highest, and it drives price down. And in this case here, zip Zion was going up and going down, and in both days you had a red candle. Sometimes zip Zion can go up and the price will go up slightly but so much of the time Zip Zion, when it's higher, ends up going down. And the classic, of course, is after the gap up here, we have Zip Zion highest for many days, and you can see that as the price goes down, Zip Zion goes down as well. Now, all that being said, I want to get back to the original discussion rather than continue on that particular rabbit trail. The next thing that I want to point out is and compare is the physical height of the lines. Of the different lines. In the yellow line right here, power red was at minus 0.2, so it's just slightly under 0, and you know that it goes that the power red is the best position indicator line that we have, and when power red is under 0, it has a tendency to go down. When it's over 0, it has a tendency to go up, generally speaking, especially if the lines are running flat. The day before, power red was at minus 4.4, and then it's up here at minus 0.2. So it's gone up 4.2 points in one day, but it ended up under 0. Whereas over here, the power red went up just about 5 points from up to 1.75 from minus 3.3. So the location, the height of power red being at 1.75 at the same time the crossover occurred is key. Even though we didn't have a crossover in the power red, if the power red ended up at 0.2 instead of minus 0.2, we'd still end up with the same results, and that being we got many more days, or at least the next few days, of stagnant price movement. Now, the other line I want to compare or look at is Zip Zion over here the day before the yellow line, I mean Swing Zion, is minus 3.2. The yellow line is with Swing Zion is at 0.19. So this has gone up about 3.4 from the day before to the day of the vertical yellow line, whereas the green line on the day before, the Swing Zion line 2 days before, Swing Zion was at minus 0.88 or minus 0.9 we'll call it, and then it goes up to 2.4, and that goes up about 3.2. Those two line movements are about identical, but the physical location of the two lines, with the next to the green line it was at the 2.4, and next to the yellow line it was at 1.9. And so remember, if you haven't heard me say it before, I say it in a fair number of videos that lines close to the 0 don't necessarily move as strongly as lines at the extremities or farther out away from 0. Or I should say the price doesn't move in relation to where those lines are. And that's a classic example. Even though if you look at the swing lines and the power lines and the price lines, all of them went up fairly the same distance. So we refer to that as the DIFF, the difference between the two lines from one day to the next. But look at their price. Your price doesn't move at all in the yellow line, whereas compared with the green line, it's the second day that it goes up, and after the movement up. Now I could move this yellow line over one day and compare, and you might say, well, now you have it compared correctly, because now you have the yellow line starting. There are 2 days up on the yellow line and 2 days up on the green line, but the same situation exists. Your price green is only at 93 versus before it was at 84, and likewise your green on the day before is the first day is 131, and the second day, the green line day, is at 136 on the price green. So just some significant differences. Obviously, the ZIP green line is where it's located, because you have a high right leg W here, a 5-day or whatever it is, high right leg W with ZIP green at 100 versus looks like a 6 or 7 day right leg W with ZIP green. In this case here, ZIP green's at 47, but then the next day it's at 0. So just some key factors in line length comparisons. Remember, your line length, just like when ZIP red goes up 50 points or 70 points or 90 points, or I should say 80 to 90, we look at those ranges that ZIP red goes up. Typically ZIP red, when it goes up 50, it comes back down. Typically when ZIP red goes up 50 points or more and ends up at 90 or in that 90 range, ZIP red will go down, but the price will go up. So there's differences, significant differences in the ZIP red line discussion, differences, DIFF conditions, but the ZIP red is typically not a viable line that we use in the 3 pattern discussions, or the gap patterns. So now the other thing that I want to point out to you here is the main reason why this thing has gapped up on the day that it gapped up. Now keep in mind, I'm looking at the green vertical line day. So on the green vertical line day, we have what is a classic power 4 low angle up. The pink, blue, white, and yellow are in a low angle up position above the power orange, and we have the power Zion down. Now the power Zion can be down above the power 4 or under the power 4, but in the majority of cases with the low angle up pattern, the best position that it can occur is under it, because it typically runs into this green line as it does there, and that's in a down touch. The power Zion has down touched the power green line, and it is a divergent issue. If you look it up here at the trend chart, you have trend red is real high, trend green is going up as well. The low angle difference in the trend red is more visible than in the green, but the trend gray is in a divergent move going down, and it is down touching the trio lines, probably the pink or the yellow. I'd see if I can identify it here. Trend gray is at 5.2, and trend yellow, the pink is at 3, blue is at 5.4. So the gray line is between the blue and the pink line in its down touch. So, and it's closer to the blue, so I would say that it's technically qualified as a down touch blue line. So it's just just under the blue, and you know, a lot of times you'll say, well, it's just above the pink, so that's what it's down touching. But either way, it doesn't make any difference. And pink, of course, is stronger than blue, so maybe that's the true down touch that occurred in the trend gray line. But one thing that is again important is that the trend gray is in a higher right leg W pattern. And so now you've got trend gray in a double pattern. It's a high right leg W, it's a down touch, the trend red or whatever, or trend pink I mean, and then you have the Zion, which is in a higher right leg W pattern. If you go over here to the swing, it shows up over here better. I have it expanded a little bit more. The swing pink is in a down touch, the yellow line, and it's also in a higher right leg W pattern. And so again, you know, there's significant right leg W patterns. There's also some right leg W patterns over here in the zip chart in your red, in your zip red and in your zip gray, and as well in zip yellow and zip blue on the green line day. And so there's, I don't know what that was, 8 or 9 right leg W patterns, and that in itself is significant. That you're going to be in a 2-pattern qualification here out of or more. I haven't tried to technically look at the identical indicators in this example, because as you know, the procedure that you use is you try to find the pattern in the power 4. Then you support your evidence or identify what evidence you see in your trend chart, and then count your identical indicators in the 5 charts. In this case here, the only down touch that we have is trend gray, but that's all we need. We do need in a gap up in this low angle up pattern. We always like to see one down touch move. Typically that's in trend red or trend green, but in this case here it's in gray. And the fact that both red and green are significantly higher, especially the red, because it's so much higher than the green, but both red and green are much higher than the gray. That is, or can be, a supporting evidence to tell us that the thing is going to go up. The other thing that I want to point out here is right now on the vertical green line, power green is at minus 0.03, power orange is at minus 0.08. And so that difference is 0.05. And again, you've heard me talk about the spread difference, or the DIFF, between power green and orange, and how that needs to be close together. And if you're doing an Excel gap up calculations, column calculations on gaps up, and track that, you know how much of the time the two lines will be 0.03 to 0.08 in spread, and there's a significant number that are up to about 0.15. Interestingly, this power this gap up occurred with power green and orange just slightly under 0. And that's one of the other key things that I've told you about in previous videos, and that is that the green and orange line need to be near 0. If you go back to the yellow line right here, power green is at 0.17, power orange is at minus 0.18. Both of them are at minus. So minus 0.17 is you know, or look at it this way. The power orange at minus 0.18 is 6 times lower than the power green line at minus 0.03. So on the vertical green line. And so it may not look like much to you, but that's the difference between technical analysis and how you can identify what works and what doesn't work. And so also in this yellow line, just as a comparison, we do have trend crossing over green with the yellow vertical line, and that's technically the start of an uptrend. But we have, and you might say, well, look at the power chart. We have the power 4 in a BOC pattern, but one of the things that we don't have is the power Zion line underneath the power 4, because it's not mandatory, but you just get so many more gaps with power Zion under the power 4 or even under orange than you do if the power Zion is up above. And that should be logical when you think about it, but for some there's a difference. And so this pattern on the power yellow line is, although it looks like it's going to be a continuation pattern, and if you look at it the next day, I'll expand this a little bit so it gives us a feel of what we had. It goes up slightly, but just to expand it here, it goes up slightly, but the difference is minor price-wise. I mean, these lines over here are 10 cents apart, and so it went up the next day, but it took a deep dive as well, and you may have jumped out of the position before you got to realize the benefits by the end of the day. So the patterns are extremely important. We use them consistently within the analysis. You want to have the supporting evidence of your down touch in the trend chart with the pattern that you see. If you don't have that down touch, it just doesn't react in the same way. And you're primarily in the power 4 pattern, those 4 lines and the patterns they make. And if you go to the proximity 3 pattern gap up document, at the end of it you'll see the 7 kind of looks like 8, but there's I think I've got 8 drawings, but there's 7 basic patterns that we look at. There is another pattern that has gaps up to it, and that's when the power 4 cross over the 0 line, but it's happens more infrequently, or less infrequently, however you want to look at it. It just doesn't happen as much, so I did not include that in the examples that I have on the proximity 3 group patterns, especially on the gap up page. There's another one for the gap down page, but anyway, these are some of the things that we see in how we're looking at the differences in what makes or qualifies a gap up. I mean, you can see the importance in the combination of the different patterns or conditions that are needed. I mean, if you've done a gap up Excel program and you've tracked the spread between the green and the orange, I mean, you cannot tell me that this is not a primary condition of gap ups. I mean, you can't look at the evidence and not say that. It's just there. And so people don't realize the power in comparative analysis, and the best way to do comparative analysis is on an Excel sheet or some kind of grid column spreadsheet that you might have, whatever it is, and to identify those conditions that you need, or those patterns that you need, because you just see all of the examples of what things are occurring just prior to the gap up, and that level of supporting evidence is what drives you to make that decision that it is a gap up. Excuse me. And so the difference, those ideas, especially in the line length comparisons that I just showed you here, are significant. Some of them had crossover conditions. When you have the big three that are all doing something, because you had the power red crossover, the all three, and I mean the zero and the power green and orange, and you had the swing Zion crossover, and the trend red, of course, is the third of the big three, and that came down and did a down touch onto the zero at, I think it was 0.26. That although it wasn't a crossover, it identifies the trend red in an above zero position, and that's significant for the big three. And so all excuse me, all this being said, the line length changes are significant for a number of reasons. One of the biggest is that they alert you 1 or 2 days prior to the big movement. And you can call that a leading indicator condition. You can call it what you will. It occurs prior to a big movement. And they're not always gaps, but you'll see nice big green candles or nice uptrends. It just depends on the amount of supporting evidence that you have. So it's an exciting system that we have here at Day Trading Visual Basics. We are amazed. You've heard me say that before, but I haven't done as many types of indicator line length analysis that I would like to, and I plan on doing several more. I've got a few done already, but it's truly amazing what you can see. You just got to do your analysis, do your comparisons, and obviously I can only lead you so far. It's those Excel patterns that you see that are going to move you into a realm of our slogan of becoming a more knowledgeable, independent, confident day trader. Because the power's here. The information is here, the sensitivity is here, the ability is here. You just need to apply it by recognition. And in my mind, one of the best ways to recognize what's going on is to track it. And one of the best formulas for tracking information is your column grid system, like an Excel program. So have fun trading